We often have clients that will come to us and they're sitting on a pile of cash, but their concern is ongoing premiums in the following years. Today, we're going to do a deep dive and give you guys an option. Make sure that you know that there are options available for you in this design.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be giving you guys a case study for scenarios in which clients are sitting on a pile of cash, but their concern is future premiums in the following years. Anthony, I know you're excited about this one.
Yeah, this is it's a question that often comes up. Mm-hmm. And so we decided to do a podcast to kind of explain a few of the options that we have.
So I'm excited as well. Anthony, what do you have in store for us today to highlight this scenario?
Well, I will say, Cameron, I think you're starting off on the wrong foot. Okay.
Why do you say that?
Because I know that this case study, I put a couple options together, and I also took the liberty of writing an opening, and you totally missed it. And what it says is, you missed the part that said, I'm honored to have our in-house recovering CPA and my personal mentor, Anthony, to help us walk us through the options. So I put a lot of work into this, man, and I kind of a little insulted that, or a little hurt that you're not following the script, but it's okay. It's okay. We are going to get through this.
I did not miss it. It was intentional. I didn't include it, but awesome. All right. You ready, man?
Yeah, just realize if I'm gonna do a lot of the podcast, and I'm gonna put some digs in there.
Oh, I know.
So
yeah,
this is the first one. Let's see what else we have going on in this stellar episode.
Great, let's see it.
Okay, so what we have is we broke down three options because there's a couple different scenarios, mm-hmm. right? Because a lot of times we have clients that are interested in infinite banking. And want to start a policy, or they're looking to start their next policy, right? And maybe they don't have enough to really start a policy. So we have a total of three options. Now, the first one we've actually talked about a few times, and that's called, we have the amazing title called the one and done. Okay.
Creative.
Yeah. We call it that because you make one deposit and you're done. There's no further deposits required. So this is great when we're sitting on a windfall of cash, and maybe that came from a sale of an asset, maybe an inheritance, or we sold an asset, or I think I just said that, but we now have access to money that was locked up in our 401k. This is a great way to be able to dump that into a policy. So I'm a big fan of the one and dones, and there's a lot of advantages and some disadvantages.
Yeah, you mentioned advantages, disadvantages, right? We've said this before on the podcast, is there's no deals in life insurance, right? So typically if something's good for us, there's going to be a little bit of take, right? So maybe highlight those advantages, disadvantages briefly.
Well, what I would say is that one of the advantages is that this, to me, overcomes the biggest obstacle people have when they're doing infinite banking. What I mean by that is what we call the slow start. The first couple of years, you put in $1, you're not going to have access to a full $1. However, the way that we design this one, that loss of liquidity is minimized. And so this way we can overcome and be able to use a majority, or sometimes maybe all of that money that we are putting in. Also, another advantage is no more premiums are required. But as far as the downside, one downside is no more premiums are allowed. I mean, the way with this design, we can put limited funding in, but typically not until you're 8. So that means we can't put any additional dollars in there for 7 years. And we say that as a con because we want to reiterate, we need to think of premiums not as a payment, but as a deposit. right? When we think of it as a payment, we want to end that as soon as possible, right? But we want to view these premiums as deposits. And this one, the deposits are full. We are unable to put any more in there. So that's why I like to say that that's a pro, but it's also a con. A couple other cons will be, in order to get full access to this, we're going to have to use the LELOC strategy, meaning that we need to go to a third party, aka a bank. Instead of using a policy loan, we use bank loans. Also, in order to do the LELOC, there is a minimum. So really, for this to work, we need a minimum one and done deposit somewhere around $75,000. Also, the interest rate on a LELOC is more volatile than on a policy loan. So pros and cons, just like everything, Cameron. I like how you brought up that there are no deals in life insurance. So this is great short term, but long term, we do lose some flexibilities and some benefits on the long term.
Great. And we've talked about that option one and done before. We'll put a link in the show notes. Anthony, you made a comment there as far as kind of there being a threshold or a minimum. Are there options to discuss if we have windfalls that are less than kind of that 75,000?
Correct. Now, one option is we still do a one and done. We're just not able to leverage against the entire thing. Okay. But another option is, I'd say this is ideal, is if we have some money now, but we don't have the ability to do ongoing funding until maybe a couple of years, meaning that there's going to be a cash flow increase, say in maybe 3 or 4 years from now. And some examples of that is one of my favorites, because I've enjoyed it myself and you haven't, is when the kids get off payroll. You would be amazed how the money that you're spending, not just on food, maybe car insurance, activities, all those things going right to the bottom line, right? So if the kids are going to be off the family payroll in 3 years, you may want to start a policy sooner as opposed to waiting 3 years from now. And maybe we should do a podcast on this, which there is a cost to waiting. And, I just did one on working recently with a client where they had some debt, right? But then they wanted to start a policy, and that question, well, why don't we just pay off that policy or that debt, and it'll take 2 years, and then we start the policy? Or what if we start the policy now, use the cash value to pay off those loans or that debt, and the advantage is we're able to start a policy sooner. Disadvantage is it may take a little longer to pay off that debt, but what we did is we ran what the difference would be by waiting 2 years. And in this case, it was actually pretty impactful. And one thing we need to realize with life insurance and these designs, we're always going to have that slow start the first couple of years. And we're also at the end, we're going to have that fast finish. But so the best year of the policy are the best couple of years of your life. And if we wait a couple of years, we're still going through that slow start, but what we're giving up is a couple of years at the end of that fast finish. So I just wanted to make the point is that there's some financial benefit of starting a policy sooner. And with this design can allow you to do that. So a couple other options might be is maybe some debt is going to be paid off. Maybe the spouse will go back to work in a couple years, or maybe you have a lot of expenses with your hair care, and you know what, the hair is starting to thin, and you're like, hey, in 2 years, man, I'm just gonna have to shave this bad boy off. Now would be the time to start the policy. And what we do is it's similar to a one and done, but we use that to maybe pay for the premiums for the first few years. And then maybe when you do shave the hair off and we don't have all those expenses of Paul Mitchell and the beauty salons, we need somewhere to put that cash. and we could use that to start funding the ongoing premiums from then.
And okay, so this bears repeating here. So what I'm
Mhm.
hearing you say is that when we kind of do a one and done, is there's a general number of years that we'll design a one and done, but what I'm hearing you say is make it a kind of an abbreviated or a shorter period for the one and done. Is that right?
Yeah.
Awesome. Now again, right? There's got to be pros and cons to that. Anthony, you want to highlight some of those?
I think that the biggest pro would be is we start that policy sooner. So I'd mentioned that cost of waiting. We can minimize that cost of waiting. Also, and a lot of times I think we don't give the death benefit enough credit. But by doing that sooner, we're locking in that insurability and that death benefit. But again, there's going to be some bad or some cons as well. And the cons on this is that we are going to need some additional funding. This isn't a one and done. We haven't come up with a cool name yet, but hopefully we will for this type of design. But this will do the funding for a couple of years. But we're going to need to have some funding at some point in the future, which means if that expected windfall doesn't happen, it could jeopardize the policy. So what I like to do when we do this design is what I call it a stress test. Meaning if we do this design, let's just say, for example, you're going to do this in 4 years, you're going to have to start funding the premiums. What I want to make sure is that there's enough cash value in that policy to be able to either borrow against or surrender PUAs to pay the premiums for the next couple of years. So that way, if that windfall does not materialize, or maybe you take some medication, hair gets even thicker and better, right? And maybe the exact opposite happens. Now you got to spend more money on your hair. And now this policy we design, we don't have the funding to do so. So we want to make sure that the policy will still be able to survive if the chance happens and that windfall does not materialize.
And if your hair does grow in nice and luscious,
yeah,
dude, I'm sure you could get a modeling contract. Right? So
you would know.
Exactly. Yeah. So year 4, you might be needing to open up several other PDFs, but great point. You had something else there?
Nope. I'm good.
Man, great overview, right? So today, what we're talking about is really kind of very specific situation for clients that come to us when they're sitting on some cash and they don't have any money for subsequent premiums. There's always that question like, hey, can I even do this? To be totally honest with you guys, the listeners, that was a really, really difficult situation, 6-7 years ago. But now some of the options and the designs that we have available to us, and we can absolutely accommodate those types of designs that Anthony outlined today. So really good stuff.
Well, it's so good, Cameron. There's one more design.
Oh, wow. Okay.
We have one more option.
Okay, let's hear it.
This one, well, I like them all. They all have their own place, but I think that this is ideal when we have a pile of money and we want to put some money in. We want to have the option to put additional funding. Maybe we don't know if the money is going to be there, but if it is, we want to be able to put it in this policy. And I call this one, Cameron, you ready?
Let's hear it.
The one and done plus, because it's a one and done design plus the ability to add more premiums.
Okay.
I mean, you see the creativity.
It's just wild. Yeah.
That goes on, right?
Yeah.
And
outside the box.
Yeah. In the simplest case, what we do is we do a similar one and done where you make one deposit, no more premiums are required. But in essence, that's going to fund more of the base premium, or we like to call the have to premium. So the have to premium is already paid. But what we do is we design it so there's room for optional funding, which we call the want to premium, aka the PUAs.
Yeah.
So this will allow you to fund the premium and know, well, hey, if that windfall doesn't come in, right? If I still need to pay Paul Mitchell all that money each month, that this policy is still going to be okay. But we have that flexibility to put in additional premiums as cash flow allows. And to me, where I've used this a lot, you've actually used this quite a bit as well. You didn't have the cool name, but feel free to use it. I like this. I use this a lot with kids policies because what happens when with most of our clients or many of them have set up some sort of savings plan for their kids.
Yeah.
What's their 529 plan or just a savings account or something. So they got a small amount of money, but they still want to do the additional savings into a policy. And I know we've often talked about kickstarts as well. Yeah. We can't do a kickstart on kids because in order to do that, we need some term insurance, and you can't get term insurance on kids. But where we can get around that is this one and done plus, where we could use that savings that you have, and that can pay for the have to premium. And then there's room for you to do the additional funding. Also, I like to build room for gifts because I think we're pretty clear. Like we're big fans of infinite banking and whole life insurance, but it's not perfect. Right? There's things about it that we're not thrilled with. And one of them is there's typically that MEC line or that limit of additional deposit. So we try to design it right up against that MEC line, but we need to be able to make room for, let's say, when the kids start working, we want to make sure that they're saving the money somewhere, or gifts from parents and birthdays and from grandparents. And ideally, I like to have that savings in one account as opposed to in a policy and in somewhere else. So this can be a great advantage of being able to have that policy and still have that flexibility for additional premiums.
Great point, Anthony. And I'll add to that I liked what you said there at the end is I was thinking of the grandparents. I've got two cases that are really similar in underwriting right now. One of them where we're building in a buffer, right? Because grandma and grandpa are going to be adding money into kind of the kids' college planning for that. But then also the other scenario that came to my mind was there's actually a couple that keep their finances separate. And so what they wanted to do is they wanted to take a one and done and start that. And so they have one for the spouse and then one for the opposite. So husband and wife have their own money kind of set aside for each other. So that did come in handy there. Faso, well done. Surprisingly, gave our listeners not 3, but 4 options on what to consider. If somebody's sitting on some cash and we're worried about future premiums, we've got several options available for you. So I hope you guys enjoyed it. If you guys are out there and you guys are listening to the podcast and you think this might be for you, but you're not quite sure, man, feel free to reach out. We'd love to jump on a call with you or Anthony or myself and kind of go through the pros and see if it's a good fit for you. So feel free to reach out.
You know, one thing I want before we close, I wanted to be clear. And really, I think you summed it up best, Cameron. There's no deals in life insurance. There's some great advantages of these designs, but there's also some disadvantages. And oftentimes we get focused on some of the short-term results, which makes a one and done appealing. But we've done the analysis because one thought you may have thought of, well, why don't I just do a one and done every year so I don't have that loss of liquidity? We've done the math. That'll be good. You'll be ahead about year 3, maybe year 4. But eventually that ongoing policy is going to create more cash value and more death benefit. So the bottom line, and hopefully I think the summary is a lot of options. Right? If you can understand infinite banking and you're working with somebody who understands it, you just need to explain it. This is the money I have, and this is what I want to do. And then a good coach will be able to make an efficient policy to take that to make an efficient design for you to help you achieve your goals.
Great. Well said, Anthony. Hope you guys enjoyed this episode. Appreciate you listening.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.